Okay, fun seekers, it's time to discuss the home buying process. And as we mentioned at the end of the previous presentation, this is something that's not easily learned from listening to some professor discuss the ins and outs of home buying process or reading it in a book. You just got to live through it. Now, there's an entire army of people there to help you, but be careful. Some of them don't always have your best interests in mind. You'll learn that after you've been stabbed in the back once or twice. So let's get started on slide 19. The home buying process, determining your needs. How much can you afford? Now, we've already said this once. We're going to say it again. Get pre-qualified. Talk to a credit union loan broker or a mortgage loan broker. Get a good referral. Shop around. That's part of the assignment in Chapter 7. Now, I know some of you aren't anywhere near home buying age or in the position to buy a home. And you go there, they're going to want they think you're really interested. And when you tell them you're doing it for a community college financial class, they'll kind of say, get out of here. But if they're smart, they'll treat you well because then you'll remember, hey, this guy or gal did well for me. So where's the down payment? They want to know where it is. They want to know where it is. They now make sure they don't know no more no doc, no liar loans. They want to know how much you're making. They're going to do your credit score. They want to see your ability to make the payments. As you move to a second or third home, you can include more of the features you want. Starter home, as it's often called. Location, location, location. Very cute, right? That's what the real estate agents say. Can you park your RV? Look at the RV, the zoning laws. There's some communities that have very strict zoning laws about what you can do. You have to have a lawn and you have to mow the lawn. You can't let your lawn grow. And some people are very upset because they want to have a little farm out front, and the conditions, codes, and restrictions say no. Now that's changing around the country, especially here in California, but still. Or should you use a real estate agent? Well, okay. I said we're going to insult everybody by the end of the semester. Their job is to present your offer, negotiate the price, assist you in obtaining financing, represent you at the closing, and stab you in the back if you're not very careful. Get a good referral. Now, I've had real estate agents who said, what are you talking about? We're professionals. And I say, wait a minute, wait a minute. There's a wonderful book with a horrible name called Freakonomics, where the economist who wrote the book showed that real estate agents really aren't on the same side of the scrimmage lines, to use a football analogy. They're not always aligned with your best interest. What did he do? He looked at tens of thousands of transactions where the real estate agent represented a client and where they represented themselves. And in the data, he wasn't lying. I mean, here's the data, here's the proof. The real estate agent would keep their home that they were selling on the market longer to get a better price. But if they were selling for somebody else, they would not necessarily wait for a better offer because they don't get paid until the closing. And why wait a few more weeks for a better price when you're not going to get that much more money by, even if an extra $5,000 or $10,000 or whatever it is? I want my money soon. And when it came out, they threatened to sue the guy. Well, yeah, go ahead, sue them. It's their data. And I had a real estate agent say, oh, you should always have a real estate agent if you're the buyer because the seller pays the commission, which is generally true. It's negotiable, but that's generally true. It's customary. The same agent, not at the same time, a few years later, said, well, you should always have a real estate agent when you're selling because the commission is baked into the price of the home, so the buyer pays the commission. Now, this was the same person. Now, did I catch them? Did I jump on them and say, you just told me before? No, I just kept my mouth shut because these people have internalized this. They believe it. And anything you say is not going to change their minds. So just make sure you get a good referral, because there are people out there in the industry with integrity. Not that many, but they're there. You're going to want to obtain an appraisal. Well, that's going to happen anyway because the lender is not going to allow it not to happen. So don't worry. And should you have a home inspection, again, get a good referral, because these people are typically idiots. I mean, I have firsthand knowledge. Can't believe this guy is making a darn good living. He doesn't know what he's doing. Instead, get a good referral for a contractor, a plumber, an electrician to come out. Now they're so busy, they really don't want to do that. So hopefully you'll have good referrals, and say, I want to create a relationship with your company, because they're the people who really should conduct the home inspection. The contractor, or a carpenter, somebody who knows the structure, somebody who knows the electrician, and the plumbing. Those are the most important things. How do you determine the home value? Well, we look at a presentation. There's a presentation on Zillow, which is one of 3 major websites that help you find what the prices are, but they're not really that good. Zillow, Trulia, Redfin. I mean, they're better than nothing, but you could just get on your bicycle and ride around the neighborhood or drive around the neighborhood. Be careful. Again, the buyer's agent really is working for the seller, because the seller is the one who's actually paying the commission. Now, if you're a selling agent, you want to do your best not to find somebody who's going to buy the house without a buyer agent, without a buyer's agent, because then you don't have to share the commission. So what I would recommend to people is go around and not have your own real estate agent. This was many years ago. And just say, oh, you're just looking. And if you're really interested in the place, you say, yeah, I'm not going to have an agent, because the real estate agents, they think you don't know what you're talking about. And a lot of people don't. You were going to have, if I had an agent, you're going to have to, share the commission. So what they'll do is they'll often put your bid, they'll talk up your bid, because they don't have to share the commission. So very, very cool. Is it a seller's or a buyer's market? Well, it's been a buyer's market, seller's market for some time now, and it's changing. It's changing. So who knows? Next year, I don't think it's going to be as bad. I don't know. I didn't think the last one was going to be that bad. So what do I know? What is earnest money? Well, it's not the down payment, but it's a quantity of $3,000 to $5,000, which basically says, yes, I'm interested in buying this house. Now, the process takes weeks, maybe months, usually 60 days, 30 days, 60 days, 90 days. But I want you not to sell this house to somebody else. So you write up a sales agreement and you put down $5,000. But what you want to do as the buyer is have a contingency. Look, I'm going to put down this $5,000, because if you don't buy the house, then right, they get to keep the $5,000. But you say it's contingent on getting financing. It's contingent on me selling my house. Now, here's where it's gotten to the point where you pretty much need an agent. I can't imagine. I'm not in the market. I haven't bought in a long time, but it's gotten so complex. You might even want to have a lawyer sit down with the contingency clauses, because remember, the agents, they're looking out for the seller, because whether they're the buyer's agent or the seller's agent, because that's where the money's coming from. They're coming from the person who's selling the house. So just the takeaway is be careful. Be very careful. Now, if you don't have 20%, typically the lender's going to want you to have what's called private mortgage insurance. It's not there to protect you, and we'll discuss it in a bit, But if you can get 20% down, God bless you. It's so difficult here in San Diego. The more you put down, the better, in my humble opinion. Have you gotten pre-qualified? Did I mention? I think I mentioned that you're going to get pre-qualified, right? On your income, your assets, your debt, credit history, mortgage rates, length of the loans, and we talk about the difference between a 15-year loan, a 30-year loan, and we discuss points in that presentation we discussed. So make sure you watch that. In the face-to-face class, of course, we'd stop right now and show that. It's called a buy down. The more points they stick you with, they point at you, the lower your interest rate is going to be. And it's a good idea to buy down the loan if you intend on living in the house for a long time and if the interest rate is very good. Remember, if you refinance, we'll discuss refinancing in a bit, you're going to go through the whole process again. So maybe if you think interest rates are going to go down, I don't know. They've spiked quite high. I can't imagine they're going to stay this high. They're probably going to go back down, but then they might go back up higher again. So you don't know. There are people who are paid tremendous sums of money to incorrectly predict where interest rates will go. Who am I to think I could be somebody who would actually correctly predict? But if you were to put a gun to my head right now as a person who's supposed to know what's going on, I would say I think they're they've overshot. I think the interest rates are going to come down a little bit, but we'll find long-term interest rates, which are what mortgages are. Short-term interest rates, that's a whole different world, and that's going on. That's the Federal Reserve Bank. They control them. So if you know somebody at the Fed, you could know the future because they'll tell you, but they're not supposed to. That's quite illegal. But they've been as of it's early October 2022. The Fed has been saying we're going to keep raising short-term interest rates, and the long end of the curve, as it's called, Take Business 123, Introduction to Investments, has spiked, and I think overly so. But we'll see. We'll see what happens. That doesn't mean I'm right. Slide 23. Here's the PMI we talked about. It's just similar to PMS. A private mortgage insurance. It protects the lender from financial loss due to default on the loan. Notice it protects the lender, but you, the borrower, pay for it. What a scam. I mean, what a deal. You don't want private mortgage insurance because it's not protecting you, but it might be something that the lender is saying, look, we're not going to give you the loan unless you buy it. So if the down payment is less than 20%, often the lender wants it. When the equity builds up to 20%, they're supposed to get rid of it automatically, 22% or something like that. But they don't want to get rid of it. You're not hurting them. It's helping them. So you have to petition them. Hey, I now own more than 20% of this house. I want to get rid of the PMI. And you want to get rid of it as soon as possible. There are some sneaky ways of getting rid of it with a home equity line of credit and other ways, but I don't really know that much about it because I've never had to do it. But I've read that some people were pulling this off. They had a 5% down payment, but they were able to get a home equity line of credit for 15% and then 80% fixed. That sounds too good to be true in my humble opinion. And also the home equity line of credit is going to be more expensive than the regular first mortgage. So it might all come out in the wash and it really doesn't save you any money. There are two basic types of mortgages. There's what's often called the conventional mortgage, the fixed rate mortgage, the fixed payment mortgage, fully amortized. They usually, as we said, want 10% or 20% down, but if you got 10%, if they got 5%, if you're a first-time home buyer, you might even get away with 3%. If you're a veteran, right, they have a really sweet deal where they can often get away with 0%. But it's fixed. You know how much you're going to pay for the next 20, 30 years, 15, and whatever length of time you have the loan. If you're willing to take on some of the risk, you could get an adjustable rate mortgage. And what does that mean? Well, it's self-explanatory. It means the rate's going to adjust. You will pay less to start. They will start you off with a lower interest rate, but it could go much higher. There's usually a rate cap, which means if it starts out at 5%, it can't go more than 10%. That doesn't sound like a big difference. Wait till you learn how to compute mortgage payments. It's a big difference. And there's usually a incremental cap. It can only go up 0.5% every 6 months or a full percent every year or whatever. But still, it could go down. So you see, if you could correctly predict interest rates, and as I said, there are people who are paid tremendous sums of money with lots of letters behind their name like PhD and MBA and all that stuff. And they can't do it, but they're paid tremendous sums of money to incorrectly do it. How are we mere mortals going to do it? And the option arm, the optional adjustable rate mortgage was the loan that basically destroyed the industry back in the 2000s. And we have a presentation about that. So beware the optional adjustable rate mortgage that came with negative amortization. What a great, stupid name that nobody understands. It means the loan isn't going down, it's going up. You're not making the total interest payments that cover the interest. You're not even making payments that were making the covering the interest payments, let alone paying down the loan. So why was this allowed? Well, that was a good question. The regulators should never allow it. If you met somebody in the industry who's been in the industry for many years and said, "Oh yeah, I sold 2 or 3 of those," they made sense for somebody who was going to whose income was going to rise substantially over the next few years. What are we talking about here? You get a $500,000 loan. This is what was going on in the mid 2000s. Well, that's 17 years ago, right? $500,000 loan should be paying $3,000 or so a month, whatever. Well, they were giving it to you for $1,600 a month. Whoa, okay. That sounds pretty good. That's only for the first year. And you weren't even paying the interest. So instead of your loan going down, they were tacking the interest that you didn't pay on the loan. Your loan is going up. The next year it goes to $1,950. Okay, well, I can make that payment. And then the next year after that, the third year it goes to $2,500. And then the fourth year it resets, whatever that means, and goes to $3,000 a month. And see, people who weren't able to make those payments were suckered into buying these things, and they were allowed to say how much they were making. They didn't. The lenders didn't check. That's why they were called no doc, or more euphemistically, liar loans, because unscrupulous lenders were saying, "How much do you make a year?" "Oh, about 40 grand." "How much? 90,000?" "Oh yeah, I make 90,000 a year." So these things destroyed people's lives, and luckily they are only in very rare instances are you allowed to get an optional adjustable rate mortgage. But adjustable rate mortgages are making a comeback because a lot of people are saying, well, interest rates should not go up too much more than they are now, but if they do, these people are going to be hurting. If they go down, great, they've won. And then we talked about the VA loans and we didn't talk about the FHA loans, but the same idea. These are for people, first-time home buyers for FHA. Great programs. So check it out, folks. If you're a first-time home buyer, you're looking to buy in, you have a down payment. That's why we have Chapter 1, goal setting. We have good credit. That's why we have Chapter 5. We got our secured credit card and building our credit, making the payments every month, and we're interested in buying. So check those out. Now, some loans have what are called graduated payments. This is the typical characteristic of the optional adjustable rate mortgage. And again, these are only good for people whose income is expected to increase. For example, this person just got out of medical school or out of law school or just got their MBA or an engineer or something like that. And the next few years, their salary is going to increase quite substantially. And then there are some loans that are called interest only, IO. Don't you just love that IO? Yeah, right. You're not making any payments against the principal. Now, why would you want to do this? Well, first of all, it's going to be cheaper, right? You're going to be able to live in the place for cheaper, and you have no intentions of actually staying there. 3 years, you know you're leaving whatever community, you're leaving San Diego or you're leaving wherever you live, and you're going somewhere else. So why bother, right? And then there's another wrinkle on this called a balloon payment. You'll hear them say 30 due in 7 or 30 due in 5, or you'll just see 30/7, 30/5. So it looks like a 30-year loan, and you get a lower interest rate. Cool. Well, what happens after 3, 5, typically 5 or 7, not too many 3, after 5 or 7 years? Well, you have to refinance or sell because now you have one big balloon payment. That's why it's called a balloon loan, to pay off the loan in 5 years. Again, if you know you're going to leave the area in 3 to 5 years or 5 or 6 years, then these things make sense. And typically, depending on what's happened with interest rates, you can refinance, or if you knew you were going to stay there, you're going to sell the place anyway. So that is something that may be useful to you. I'm not a big fan of them if the person says no, or the couple says no, this is where we're going to live, this is our home, then I would not recommend a 30 due in 5 or 30 due in 7. But hey, it's one option. Okay, now we talked about the home equity line of credit back in chapter 5. Used to be tax deductible, no more, so we should cross this out. If you're grandfathered in, it is, yes. The reverse mortgages provides elderly with the income tax-free income. You stay away from these things, folks. When you see something hawked on TV by a celebrity who is not a financial professional, they're just being paid to say it, that's a bad sign. And there are some articles about how reverse mortgages came back to bite the individuals. So stay away from the reverse mortgages. And they're only for people, I think they're going to raise the age. I think it started at 62, but they're probably going to raise the age. Now, we talked about shared appreciation. Some lenders will say, hey, we'll lend you money. Hey, here's a catch. We want to share in the appreciation of your home. That's never done at banks or credit unions. They don't want to do that. That's very, very shady, because what these unscrupulous lenders would do is they would get somebody to appraise the house for far less than what it's worth. And this was a big problem 20 some odd years ago. And regulators were really coming down hard on these people, the charlatans who were getting, let's throw some numbers out. If a house is worth about $400,000, they would get the appraiser to appraise it for $200,000. Let's make them big round numbers. You see what they just did? The house was worth $400,000. Now, if it goes up to $500,000, if a honest appraiser had appraised it at $400,000, they're going to share 50-50 in $100,000. But if an unscrupulous appraiser had appraised it at $200,000, they've immediately made over $150,000 now, because now it's gone from $200,000 to $500,000, and they expect you to share in that bonanza. So again, if you don't understand what's going on, or even if you do, consult a lawyer for a reverse mortgage, shared appreciation. Now, if you want to refinance, that's a whole different story. Again, with a reputable lender, interest rates have fallen. Hey, it makes sense to get a better interest rate. And part of your assignment, there's an exercise that shows you, hey, you got to pay the closing costs all over again. You got to pay the points. And so it does make sense to refinance in some situations. The rule of thumb is if you can get an interest rate 2% lower than what you're paying, it's almost always a good idea to refinance, especially if you plan on living there a long time. Again, if you're going to move, yeah, no problem. Okay, so slide number 27. It used to be almost impossible to compare apples to apples when shopping for a loan. A lower interest rate was usually a come-on in exchange for being soaked with what are called garbage fees. Loan applicants often were not made aware of these extra fees until the day of the closing. They would have a fee like $15,000 loan distribution fee. What's this $15,000 loan distribution fee? That's the $15,000 loan distribution fee. What are you charging me $15,000 to write a check? Is that what you're doing? Yeah, as a matter of fact, we are. And so no more of that. Now the new rules forbid bait and switch maneuvers that used to be commonplace. And it took the Great Recession, it took the home debacle in the 2008, 9, 10, 11, and 12 before finally the home loan reform advocates got their way. So they're supposed to give you a GFE, it's called good faith estimate, because really they quite literally don't know what the actual amount is until the day of closing, because it changes every day. There's an extra charge for interest and the like. So you can't get exact numbers, but you should get close enough so that there's none of these $15,000 tack-on fees the last day. Poop. Oh, yeah. And then the question becomes, should I have a large down payment? Should I pay off my mortgage early? These are the same questions. People will often ask me, should I pay off my mortgage or should I put more money in my retirement account? And I say yes. And they say, but wait a minute, that was an either or question, not a yes. No, they're both good ideas. You know, you have some disposable cash. Yeah, put it in your retirement account or put it against the loan, because both of those are excellent long-term results. You're going to hear differently, right? You're going to hear real estate agents say, no, don't bother paying down your mortgage. You're going to buy a new house every 4 or 5 years anyway, right? So she can make another commission. Or a financial representative say, oh, you should invest the extra in a mutual fund so I can make another commission. I says, if you intend on staying in your house for more than a few years, sure. If you believe this is your home, because if you talk to people who've paid off their mortgage, they will tell you their stress level is far lower than it used to be when they had that darn mortgage. So think about it, folks. We're going to talk about 30-year loans, 15-year loans, 20-year loans, and most people will be able to afford a 30-year loan, and you can still make payments against the loan. You can make additional principal payments and maybe knock it down to 25 years or 22 years. And we'll discuss mortgage payments soon enough, so don't worry. Should you refinance? We discussed this very quickly. Let's take a look at it in detail. When interest rates trend lower, many homeowners consider refinancing their mortgage and getting a lower interest rate. The payments are going to go down, but you have to pay the points and the closing costs all over again because you're essentially selling the house back to yourself. The rule of thumb is if you can get your rate down by 2%, which I already mentioned, my apologies, then go ahead and refinance. But here's the kicker. Some companies offer these very low cost refinancing, maybe $400 or $500. Now, they're not going to give you the best rate, folks. They're going to not give you a very good rate. But if it's a lot better than what you're paying, sure, go right ahead. It'll pay for itself in a few months. Typically, it takes 2 or 3 years for you to pay back those closing costs. And there's an exercise, as I said, one of the exercises in the assignment in Chapter 7 is that payoff. How long does it take to save the money that it cost you to refinance the closing costs. And so it can take several months, maybe a couple of years. So the lower the interest rate, the better. But remember, you have to buy the loan again, points, closing costs, and stress. Buyer's remorse is real, folks, and refinance remorse isn't as bad as buyer's remorse, but it's stressful, let me tell you. Okay, here is the closing transaction. Why do we call them closing costs? Because you close your eyes and you sign. They're going to throw a big stack of documents in front of you, and you got to initial every one and sign some of them, and you just want to go crazy. Oh, please don't do this to me. That's why I say close your eyes and sign. But don't skim through it. Make sure you understand to a minimum what you're signing. Title insurance, what's that? We'll talk about that in a minute. The escrow fee, that's the bean counters, the people doing all the transactions. Some areas of the country, it's just de rigueur to have an attorney. It's just expected. Others, California is one of them, where you don't really need an attorney, but you might want one, especially if you're dealing with somebody who you just have this horrible feeling that they're trying to rip you off. The appraiser's fees and the property survey, the recording fees and the transfer taxes, the credit report, the termite inspection, the lender's origination fee, which is the fancy word for the points, the tax, the insurance, the prepaid interest, the commission. Insist on a walkthrough the day before. Sometimes in the sales agreement, there'll be a chandelier or the washer and dryer, and you say, well, you're going to take the washer and dryer? No, we're not taking it. You can have it. So it's in the sales agreement that the washer or the chandelier or whatever is going to be kept. You get the keys, you walk in that day that it's already closed, and there's no chandelier, or the washer and the dryer are gone, or whatever, a jacuzzi or whatever wasn't tacked to the floor. Well, you're kind of out of luck. Oh, we're sorry, the movers accidentally took it. It's on its way to Bremerton, Washington. So the day before, if you say, hey, excuse me, you said that chandelier was going to be there, then you can, and they say, oh, busted. They'll knock the price off. They'll take the price of the chandelier off the closing costs. The big jerk. Yeah, folks, I can tell you that there are people out there who really don't care about you at all and will stab you in the back, and they won't feel any remorse whatsoever. So insist on a walkthrough. Now, what's title insurance? Well, people don't really understand title insurance, but it's very important. It guarantees that the seller is who they say they are and actually owns the properties, and that there are no other liens, which is a fancy word for a charge against the property. Encumbrance is another word. Oh yeah, they still owe $20,000 when the roof was repaired and they never paid the contractor. It's called a mechanic's lien. So that's the job of the title insurance company. If your home was purchased or refinanced within the past few years, you should ask for and you should get a discount on the title insurance policy. Now, it definitely pays to shop around for title insurance. Your real estate agent, your lender, is going to recommend somebody, and often they'll act like, well, of course you're going to use our person. You don't have to, and they're not supposed to get a kickback. I think it's illegal, but I think it happens all the time. It's my understanding. I don't work in the industry. I told you we're going to insult everybody by the end of the semester. Wait till we get the stockbrokers. But so it pays to shop around. Don't expect that they're going to give you the best deal. There was one study, I forget where it was, Iowa, I think it was. Title insurance, when they allowed it and promoted, actually the state allowed it and promoted competition, rates just fell dramatically. Yeah, because there's not much they have to do, really, folks. It's all electronic now. Sometimes they have to do some investigation, but they make $1,000 for a couple hours worth of work. Not a bad deal. Okay, we've discussed buying a home. Let's discuss selling a home. There's this wonderful gentleman, we'll come back to him later on, Jay DeSima, who writes these books about real estate. He says, put a white picket fence in front of your house. That increases the value And I think appraisers' fees are probably a lot more because I'm old. But I still have $350. It's probably like $400 or $500 these days. The realtor says, "Hey, don't worry. We'll come up with a selling price for free," because they want the sale, right? They want to make the sale. So I don't know. I would just run around the neighborhood myself and check out the prices. It used to be. It used to be that you could sell the house yourself, but I don't think, even though I have sales experience as a insurance agent, as a stockbroker, I often thought if I'm going to sell my house, which I'm probably never going to do, they're going to bury me here in the backyard, I guess, throw my ashes. Uh, I would go get my real estate license just so I could sell my own house. But I have sales experience, so I understand, okay, what I got to do, what these forms, make sure I understand these forms. But it's gotten so complex that I must admit I probably wouldn't do it. But it's a moot point because we're never going to sell our house, so it doesn't matter. But you could do it, possibly. Get your real estate agent's license and sell your house and save a ton of money. Because remember, real estate agents don't always have your best interest at heart. We can give you the name of somebody who's very, two names of people who are very honest, which is, again, a very important commodity in that industry. Keep your back to the wall. They're going to tell you that the percentage is 6%. It's negotiable. For you, 6%. But hey, today we're having a sale. 6%. Now, I've seen it lower. In fact, if you are coming to the sales agreement, you're looking at selling, and you've already know somebody who's interested in buying, because of course houses are hot commodities. They'll lower it even more because, hey, they'll go down to 4 or 5% if they have to, because they want to get the commission. But just be careful. Get a good referral, please, please, please. I can't tell you. I don't want to get into it. You know when you start to feel the blood trickling down your back that you've been stabbed. Slide 33. What are the tax consequences? Well, if it is your principal residence, and we'll discuss this later on, we get to investments and real estate investments. There are tremendous advantages to owning your own home when you go to sell. If you're single, you could sell your house for $250,000 more than you paid for it and not pay any capital gains. If you're married, double it. That means you sold a house for $200,000. You could sell it. I mean, you bought the house for $200,000, 30 years ago, 40 years ago. You could now sell it for $700,000 and not pay any capital gains. And you can do this every 2 years, which is pretty darn sweet deal. You'll hear some old timers talk about, no, can't you only do it once? No, that was the old history. You can do it every 2 years. San Diego, it's kind of difficult because you're up against really some of the best real estate investors in the world. But in other areas where you can find fixer-uppers, and there are people doing it, they are handy with with carpentry, maybe do a little bit of electrical, a little bit of plumbing, and they buy a fixer-upper, usually have a day job. They live in it for 2 years, fix it up, sell it, for a couple $100,000 more or maybe more, and they pay no capital gains. Very, very cool. Every 2 years. Now, if you have a loss on your home, sorry, no capital losses. Why? Because the tax law agrees with me. It's a home first and investment second. Now, this has nothing to do with if it's rental property. We'll discuss that later on. But and there's a wrinkle. If it is a rental property, you can rent it out for 30 years, live in it for the last 2 years, and then sell it and still take advantage of the capital gains tax advantage. But there are other issues that you have to deal with, and we don't want to get into these. As we say in the Introduction to Investments class, real estate is a world unto itself, and it's a world where it's very difficult to teach or learn from a book. You sort of got to be in the inside of the industry, which is why when I find students in the Introduction to Investments class who are interested in real estate investments, I say, get a job in the industry. Work at a property manager or a title insurance company or a real estate company or an escrow company. Become an appraiser. Boy, will you know the industry. And then you will know the industry from the inside out. And you'll have your eyes wide open because you just shake your head when you hear some people talk about what they intend to do. Good luck. Okay. So finally, burbled on for 40 minutes and 16 seconds. How do we calculate mortgages? Well, it's very, very similar to the future value calculations that we did back in chapter 1. Of course, there are programs and applications and spreadsheets and the like, but we want you to learn how to do it manually first, and then you can use these little applications. So here's the example we do in class together, and then there's a worksheet that we do in class together. So we'll do this one together, and then do the worksheet, and there's a presentation. So do these. If you do them a few times, okay, I got it, I understand. Before there were handheld calculators and cell phones and computers, when you'd walk into, and this was a long time ago, folks, I'm old, you would walk into a mortgage company, mortgage broker, or credit union department, or bank department for mortgage, and you would see these booklets of these tables, books of these tables, calculating mortgages with a very inexpensive. Well, at the time they were expensive, but a very rudimentary calculator. So let's say interest rates. If you downloaded the presentation just a week ago or so, I had different numbers here. That's how fast interest rates are changing. My apologies. So I think this is too high. I think by next year it's going to be lower, but doesn't mean I'm right. Okay, it doesn't mean I'm right. 6% is what you see a lot of 30-year loans advertised. There are some more, some less, but 6%. If you go with a 15-year loan, they'll immediately drop the interest rate 0.5% or more, and that's a rudimentary aspect of lending. The longer the money is out there, the more the interest rate is, the higher the interest rate in general. Now, there are some weird exceptions that we won't get into, but in general, if you're going to leave the money out there for 30 years, as a lender, you're going to expect a higher interest rate than if you let the money out for 10 or 15 or 20 years. So now how do we do this? Well, this is a $400,000 loan. So we're starting with a little condo, I guess, in San Diego, or a mansion in Youngstown, Ohio. And we want to calculate the loan monthly payment. So what do we do? What's this guy? Payment per $1,000. So this is the remember the future value multipliers? This is the mortgage multiplier. So we go to our amortization table, which I've handily downloaded to my laptop here. But it's on the website, and it's on the worksheet, and it's on the website, and you're going to use it for the assignment and the exercises. So I'm going to click on it here. We do the same thing we did with the future value table. Here are the years across. So we're looking for 30 years. There's 30 years. Remember, it's the third one up because it disappears off the edge. So here's 6%. So we go across the 6% down to the third from the bottom, which was the 30-year. There it is, 30 years. I notice I doubled it because I cut them up and pass them out and save paper in the face-to-face class. So 5.996. You got it? Go across 6% down to 30 years, or you could go down to 30 years and cross 6%. We're equal opportunity mathematicians here. And it's 5.996. Now, what does that mean? What does that number mean? Well, that means for every $1,000 that you borrow, you're going to pay almost $6. $5.99.6, precision. We're borrowing $400,000. So to do this calculation, folks, the first thing you do, and this is where people forget, they forget to do this, is cut off the last 3 zeros. Just cut them off. Just get rid of them. Or you could divide by 1,000. It's up to you, but if you just remember to kill the last 3 zeros. So you multiply 400 times 5.996, and you get almost $2,400. $2,398.40. That's what you're going to pay for 30 years. Now, $2,400, that's a lot of money, but some people are paying that for 2-bedroom, some 1-bedroom apartments are going for that. So, hey, if you can get that down payment and you can pay 6% interest, you might do better than if you paid the rent. But I'm thinking rents are going to fall. We're going to see. We're going to see. Well, who knows the future? So that's for 30 years. So how the number of payments? How do I get this number? Well, it's pretty straightforward. 30 years times 12 payments per year. 12, because there's 12 months in a year, is 360 payments. So we're going to pay $2,398.40 for 360 months. And that's $863,424. Do you understand why your banker is always so happy to see you when you walk in the door? Yeah, but wait a minute. We borrowed $400,000, so the interest is really only $463,424. Right? The $400,000 wasn't ours. We borrowed it, but still, $460,000 of interest over 30 years. Yeah, folks. If you had done this just 2 years ago, it would have been a whole lot less because interest rates were in the 3% range. 3, a little more 3, a little less than 3, depending on when you got them. Yeah, oh well, interest rates have spiked. You talk to your loan broker and you say, well, Ms. Loan Broker, we're making bigger payments than that for our rent right now. We think we can handle a bigger payment. So she'll say, fine, we have a 15-year loan that's only 5.5%. Okay, let's see what the number is. We go across to 5.5%. Have to move this a little bit over. But now we only go down to 15 years, and we see that is 8.171. You might think it's twice as much. No. It's not going to be, 6 times 2. It's not going to be $12. It's $8.17. So 8.171. Let's go back. And that is the multiplier. So we multiply again, cross out the last 3 zeros. Make sure you do that. If you don't do that, you're going to get a really big number. And that's not going to be your monthly payment of $1 million or whatever. 400 times 8.171 gives us a payment of $3,268.40. Now, it's a lot more than the 30-year loan, but it's not twice as much. It's $870 more every month, and you have to pay it. Remember, you signed all those contracts. But you only have to do that for 15 years. And 15 years times 12 payments per year is 180 payments. So when you multiply the $3,268.40 times 180, you get a whole lot lower number, $588,312. So you see the total amount of the loan is what? Almost $300,000 less. And if you subtract the $400,000, you wind up with $188,312 of interest. You can spend almost $300,000 less with a 15-year loan, but that means coming up with the extra $870 each month. Now, as we said, hey, I can make these payments, and maybe I can pay a little bit more, but I don't want to commit to making these payments every darn month. Fine. Get the 30-year loan, and then every month make an extra $100, $200, $300, $400 payment. Make sure you tell the company it's an additional principal payment, because they're going to try to pay it against future interest, because that means they're going to make more money. So you say, no, I want an additional principal payment. And you'll knock it down from 30 years to 25 years or 22 years, which is, again, it sounds like a long time, and it is, but it isn't. Wasn't it just a few years ago we were partying like it's 1990? No. Wait till you have a kid, then time just speeds up. Einstein said time was relative. He's absolutely right. The older you get, the faster it goes. So this is how you do the mortgage payments. It's very similar to the future value payments. And in the face-to-face class, we would now jump to the mortgage worksheet, which is in Chapter 7. There's an answer key, and there's a presentation and commentary that shows you how to go through these. And then on the assignment, you're going to do the same thing, and then they're going to be on the exam. So please learn how to do these. It's bad for my self-esteem when you just leave the answers blank on the test. I feel so bad. I don't know what to say. I say, come on, ask me for, I'm here. I want to help you. We want you to be awesome, but you got to do your part. Okay. Think about how much you've learned. Thank you so much for being in our class. Study and work on Business 121 principles of money management every day, and you are a rising financial guru. You're not there yet. Wait, we gotta wait till towards the end of the class, but you are going to be the financial guru for your friends and family and coworkers, and they are going to depend on you. It's a very important and weighty responsibility. Thank you for being in our class, dear future financial gurus.